People don't lose money because they lack intelligence. They lose it because they can't stay patient. Impatience causes people to chase trends, panic during market volatility, and abandon a successful financial plan right before it starts working. Today, I'm going to show you why patience in investing matters more than intelligence, why time in the market beats timing the market, and how long-term investing, financial discipline, and compounding returns quietly build real wealth, while impatient investors stay stuck. Before we dive in, make sure to subscribe to the channel. Here on Life Plus Money, we break down financial planning, smart investing decisions, and wealth-building strategies that actually work in the real world, without hype, fear, or shortcuts. If you stay with me until the end of this video, you'll understand why patience and discipline are the real edge in investing, why so many people unknowingly sabotage their own investment strategy, and how to build wealth over time without stress, panic, or emotional investing. Why patience is the invisible advantage. Patience doesn't feel productive. It doesn't feel exciting. It doesn't feel like progress. And that's exactly why most people struggle with it. In wealth building, patience is often the difference between people who quietly win and people who constantly feel behind. The market doesn't reward intelligence nearly as much as it rewards behavior. You don't need to predict the future. You don't need perfect timing. You don't need insider knowledge. You need a clear financial plan, emotional control, and the ability to stay invested when everything inside you wants to react. Short-term thinking is the real problem. Most financial mistakes come from short-term thinking instead of long-term thinking. People check their accounts daily. They react instantly to headlines. They confuse short-term noise with long-term signals. This leads to emotional investing, panic selling, chasing performance, and constantly second-guessing decisions. Behavioral finance research shows that the average investor dramatically underperforms the investments they own, not because of bad assets, but because of bad behavior. The plan itself usually isn't the problem. Impatience is. And impatience quietly destroys compounding returns. Time in the market beats timing the market. One of the most powerful ideas in investing is time in the market. Not timing. Not predicting. Not reacting. Markets go up. Markets go down. Markets move sideways. Volatility isn't a flaw in the system, it's part of the system. But over long periods of time, patient investors benefit from wealth over time, while impatient investors reset their progress again and again. Every time you jump out, you interrupt growth. Every time you panic, you lock in losses. Every time you chase, you arrive late. This is why long-term investing works, not because it avoids discomfort, but because it survives it. Compounding returns need time to work. Compounding doesn't explode overnight. It crawls. Then it walks. Then, quietly, it accelerates. Most people never experience real compounding because they quit too early. They interrupt the process by selling during downturns, constantly switching strategies, or abandoning consistency after a bad year. Consistent investing, even when it feels boring or unrewarding, allows compounding returns to do the heavy lifting. Patience gives compounding the one thing it needs to work: time. Dollar cost averaging removes emotion. One of the most underrated patience tools is dollar cost averaging. Instead of trying to guess the perfect moment, you invest consistently regardless of headlines, emotions, or short-term market movements. You invest when things feel good. You invest when things feel uncomfortable. You invest when the market is calm and when it's chaotic. This removes fear, greed, and decision fatigue. It replaces emotional reactions with strong financial habits that support long-term success. It's not flashy. It doesn't make headlines. But it works. Quick reality check. Let me pause you right here for a second. If you had to be completely honest with yourself, how many investing decisions you've made were driven by emotion, not logic? Fear of missing out. Fear of losing money. Fear of being wrong. Now imagine removing emotion from just one decision going forward. That's what patience really does. It doesn't make you smarter. It makes you harder to shake. If this is helping you think differently about money, hit the subscribe button. This channel focuses on financial planning, investment mindset, and building financial freedom the smart way, with patience, discipline, and clarity. Emotional control is the real edge. Markets constantly test your emotions. Fear during downturns. Greed during rallies. Regret after missed opportunities. This is where money psychology matters more than spreadsheets. Successful investors aren't emotionless, they're disciplined. They understand that volatility is normal, discomfort is temporary, and long-term plans don't require constant action. Patience keeps emotions from hijacking smart investing decisions. Risk management keeps you in the game. Patience doesn't mean ignoring risk. It means managing risk so one bad decision doesn't knock you out. A strong investment strategy includes diversification, risk management, realistic expectations, and understanding your tolerance for volatility. The goal isn't excitement. The goal is staying invested long enough for your financial plan to work. Buy and hold is a strategy, not laziness. The buy and hold strategy often gets misunderstood. It's not about doing nothing. It's about doing the right things, and then not undoing them. Buy and hold aligns perfectly with long-term investing, compounding returns, and financial discipline. The hardest part isn't choosing investments. It's having the patience to let them work without interference. Retirement planning is a long game. When it comes to retirement planning, patience is non-negotiable. You're not investing for next month. You're not investing for next year. You're investing for decades. Those who stay consistent, patient, and disciplined are the ones who build financial freedom and sustainable passive investing income. Those who panic reset the clock, sometimes permanently. Generational wealth is built slowly. Building generational wealth isn't about one massive win. It's about decades of smart decisions, avoided mistakes, and emotional restraint. Wealth compounds quietly. Mistakes compound loudly. Patience protects you from the most expensive financial mistakes to avoid, the ones driven by urgency and fear. The true cost of impatience. Impatience shows up as overtrading, chasing trends, abandoning your financial plan, and making short-term decisions with long-term consequences. Most people don't lose because the plan was bad. They lose because they couldn't stick to it. What every successful financial plan has in common: every successful financial plan shares one trait. It survives bad days. Not perfect days. Not lucky streaks. Bad days. Patience is what allows your plan to survive reality. If this video helped you see money more clearly, subscribe to the channel. Here on Life Plus Money, we focus on long-term investing, wealth building, and financial freedom strategies that actually hold up over time, not hype, not shortcuts. Patience isn't passive. It's intentional. It's choosing discipline over reaction. Time over urgency. Progress over excitement. And in investing, patience isn't just a virtue. It's the secret behind every successful financial plan.